Gold continues its choppy movement, with the $2660 level proving to be a critical battleground. Can the upcoming non-farm payrolls data ignite a decisive trend for gold? And what kind of factors could shape the trading environment for gold in the first quarter of 2025? Find out all the answers in the latest episode of As Good as Gold. Happy New Year, fellow traders! I'm Dylan, a research strategist at Pepperstone. Welcome back to the latest weekly update on As Good as Gold. Over the past week, gold has largely maintained its choppy trend since mid of November of last year. Robust US economic data and the Fed's cautious stance on rate cuts and a strong dollar have weighed on prices, while central bank gold purchases and some geopolitical risks have provided underlying support. This week, market attention is focused on the FOMC meeting minutes, potential Fed signals regarding the rate trajectory, and also the non-farm payrolls report. Key events likely to influence gold's performance. So, as always, today's video will be divided into three sections. The first one would be technical analysis, followed by driving factors, and finally, some key risk timing. So, let's get started. Looking at the daily chart of gold against US dollar, we see that gold has reinforced the converging triangle pattern formed since November during the holiday season, trading between $2,600 and the $2,660. The balance between bullish and bearish forces remains quite tight, with the 50-day moving average providing significant resistance. Should the bulls manage to break out, the September high of $2,685 will be the next hurdle before gold can attempt to reclaim the $2,700 level. And conversely, if the bearish momentum picks up, the December low of $2,580 could serve as support, mitigating the downside. Well, gold's current consolidation reflects a simultaneous presence of bullish and bearish forces. Recent price fluctuations have largely stemmed from rumors and denials regarding U.S. tariff plans. The U.S. media suggested that Trump's tariff measures might target key imports rather than the across-the-board approach emphasized during his campaign. This narrowing policy scope offers some relief to equity traders for sure, while pressuring gold. However, Trump later dismissed the reports as unfounded, prompting some buying interest to return to the gold market. So overall, this has been no significant shift in fundamentals actually. While on a broader time frame, bearish pressure mainly stems from a strong dollar. The slow progress in cooling U.S. inflation, coupled with resilient labor market and consumption data, has kept the Fed's focus on inflation control. The latest ISM manufacturing PMI showed improvement, while the services PMI exceeded expectations, though the price paid component raised some concerns about the inflation, as we just mentioned. In this environment, the Fed appears likely to adopt a more cautious approach to rate cuts. The sentiment has kept the yield on 10-year treasuries at a high of 4.6%, while the dollar index climbed to as high as 109.6, exerting pressure on gold. That said, gold's 27% rally in 2024, its largest annual gain since 2010, also underscores the strength of bullish forces. Ongoing central bank gold purchases, geopolitical tensions, and a shift in monetary policies across most developed markets, from tightening to easing, have been key drivers of gold's strong performance last year. In my point of view, these themes, alongside continued trade frictions and tariff negotiations, are likely to boost gold demand in 2025. Meanwhile, a surge in U.S. debt issuance has exacerbated the country's debt issues, with public debt now nearing $29 trillion. This adds to safe haven demand and provides a supportive floor for prices. So all in all, gold remains in consolidation. A strong dollar limits its upside potential, but the broader context of rate cuts in developed economies and safe haven demand prevents excessive shorting. This week, Fed's Governor Waller's speech and the FOMC meeting minutes could hint at a more cautious and gradual Fed approach to rate cuts, potentially pressuring gold. And of course, Friday's December US non-farm payrolls report will significantly shape the expectations for the Fed's Q1 monetary policy. The market currently anticipates 160,000 new jobs added, down from the previous 227,000, with the unemployment rate expected to remain steady at 4.2%. I mean, if the headline number exceeds 200,000, the Fed's cautious stance on rate cuts will likely to be reinforced, leading to a stronger dollar and weaker gold. Conversely, if job growth falls below 140,000 and the unemployment rate rises to 4.3% or even higher, traders may increase gold holdings to hedge against uncertainty in the US economic outlook. In such a scenario, gold could see modest gains. So that's pretty much all for this week. If you find this video helpful, don't forget to subscribe, like, and spread the love. If you have any ideas on how the upcoming data and events would impact gold trading, drop a comment below and let's chat about it. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading!